Are you planning to invest? One of the first things you have to be able to do is to be able to compare between different investment opportunities. So join me and we're going to discuss yield, net yield and ROI together. Let's say you've got 25,000 to invest, but you're not sure where to invest your money. Your option one is to buy a property. For example, this house, which at the moment is being sold for £100,000. You can put this young couple in your property and they will pay you £800 in rent every month. That's a rental income of £9,600 per year. Of course, to be able to buy £100,000 with the £25,000 you've got, you have to go to a bank and borrow the remaining £75,000. This way, your £25,000 is generating £9,600 of income for you per year. Let's say your option two is, instead of buying a house, to buy a flat in this block of apartments. The apartment you're interested at is also going for £100,000. So similar to the previous scenario, you can put your £25,000 as a down payment, go to the bank and borrow the remaining £75,000. You can then put a tenant in your property who is also going to give you £800 per month, which is equivalent to £9,600 per year. Let's say your third option is to go to a stock market and buy a high dividend paying stock. For example, this company, which is paying around 7.2% dividend per year. So to do that, you go to a broker, pay them £25,000 and they will give you £25,000 worth of stocks. So then the question is, which one of these investments is the best for you? One way to answer this question is by calculating yield, which comes based on this simple equation. You take your income from your security and you divide it by the purchase price of that security. So in this example, for the house, it's 9,600 divided by £100,000 of purchase price, which is 9.6%. For your flat, the figures will look very similar. So you've got £9,600 worth of rent and you bought the flat for £100,000, which again gives you a yield of 9.6%. For your stock, you're expected to receive 7.2% of your capital investment, which is 1,800 in dividend. And if you divide this by your 25,000 initial purchase price, you will get to your 7.2%. Based on yield only, you may conclude that your house and the flat are equally good and superior to your stocks. But one thing you have to remember is that being a landlord is not free and there are a number of costs which you incur. For example, let's have a look at potential costs of being a landlord for the single dwelling house. You will be looking at repayment of your loan to the bank. Let's say in this example that's £500 a month. You have to insure the building as well as you have to take on landlord insurance if you wish to, and that's about £30 a month. You also like a professional management company to look after your tenants. And let's say in this example that costs you £60. So in total, you do have a liability of £590 per month, which is £7,080 per year. So if you deduct your £9,600 worth of rent from your liability of £7,080, you will come to £2,520 of net rental income. Let's have a look at the list of liabilities for our flat. Again, we have borrowed from the bank and we have to pay them £500 per month. You still have to take on insurance, which is about £30 a month. And let's say you've got the same management fee of £60 a month. But also, because it's a flat, you also have to pay what is known as a service charge, which is the bills for your communal area, maintenance of your lift, cleaning of the communal areas, etc., etc., which is bringing your total liability to £710 a month, which is £8,520 per year. By the time you have paid your liabilities, you'll be left with £1,080 of net rental income. Now, let's have a look at our stocks and our brokerage. Most brokers, they charge you a fee for having live stocks with them. For instance, in this example, we're looking at £8 per month, which is going to cost you £96 a year, which is going to reduce your annual earning down to £1,704. Now, if you look at these figures again, you will soon realize that looks like the single dwelling property is the best of the three in terms of your net income, followed by your stocks, followed by the flat. To be able to show this, we use a different marker called the net yield. Your net yield is calculated by dividing your net annual income, in this case £2,520, over your purchase price of £100,000, which in the example of the single dwelling house equates to 2.5%. You can of course do the same for your flat and divide £1,080 over 100,000, and that's going to give you a net yield of 1.1%. And if you do the same for your stocks and divide your £1,704 of net income over your purchase price, which was £25,000, you will come to a net yield of 6.8%. Now you might think to yourself, something here is not right, because your single dwelling property was giving you the best net income. However, your stocks come out first when it comes to net yield percentage. So maybe net yield is not a good variable to be able to compare across different investment classes. What you have to remember is, in stocks, you paid £25,000 to be able to acquire £25,000 worth of stocks. While in the two property examples, the bank was able to magnify your £25,000 and allow you to purchase a security which was worth a lot more. So let's agree that maybe net yield is not the best when it comes to comparing between different classes, and let's use a different variable called return on investment. To calculate return on investment, also known as return of capital employed or ROCE, you divide your net income from your investment over the amount of cash that you had to put down for your investment. So in the case of the single dwelling property, that comes down to 10.1%. And if you do the same for your flat, i.e. dividing £1,080 over your initial cash of £25,000, you will come to 4.3%. And if you repeat this for your shares of stock and divide £1,704 over your initial capital of £25,000, you would expect to come to the figure of 6.8%. Now, it looks like your ROI is a lot more representative of what your investments are doing in real world. So in this case, your single dwelling is performing better than your stocks, which is performing better than your flat. So when it comes to investment, you have to remember not only to look at the purchase price and the gross income of your investments, but most importantly to your liabilities. Did you enjoy this video? If you would like me to make more of these free educational content, please don't forget, like this video and also share this video on your social media. See you next time.